If you're heading into retirement with what most advisors call a safe portfolio, something like 60% stocks and 40% bonds, you might be sitting on a mathematical mistake that standard advice has been repeating for 40 years. You've been told that as you get older, you get more conservative, move more money into bonds every few years, protect what you already have. But for a specific kind of retiree, doing close to the opposite, starting retirement with only 30% in stocks and raising that number a little every year after, could leave you with roughly 5 times more money by age 85 than the person who followed the standard playbook. Here's the part nobody puts in the headline. If you try this inside a regular 401k or IRA, without accounting for the required minimum distribution rules that start at age 73, along with the tax drag those forced withdrawals create, your safe 4% withdrawal rate can quietly collapse down to something closer to 2.8%. That's the difference between a comfortable retirement and one where you're watching every purchase. Today we're looking at what's called the reverse equity glide path. I'm going to walk through the exact mechanism that lets a retiree who starts out looking more conservative end up with $2,100,000 more than a neighbor who did the opposite, retiring the same year with the same amount of money. And I'll show you the specific tax trap tied to the 2026 deduction rules that can erase that entire advantage inside of 10 years if nobody tells you to plan around it. If you're between 55 and 65, and some part of you worries that playing it safe with your portfolio might actually be the riskier move, subscribe to Wes Investor. We spend our time on the math the big banks don't put in their brochures. Sequence of returns risk is the reason 2 retirees can average the exact same return over 30 years and end up in completely different places. Lose 15% in your first year of retirement, and you don't just need a 15% gain to get back to even, because you're also pulling money out to live on at the same time. You need something closer to a 35% gain the following year just to recover what you lost. Most people have never heard that number, and it's the one that matters most. It's not about your average return. It's about the order those returns show up in your life. That single detail is missing from almost every retirement calculator you've ever typed your numbers into. And it's the reason the same portfolio can either make you or break you, depending on which year you happen to retire. Picture 2 people, Susan and Bob. Both retire with $1 million. Both average a 7% return over the next 30 years. On paper, they should end up in roughly the same place. They don't. Susan gets the bull market first, strong gains through her first 5 years of retirement. By the time she passes away, she leaves behind close to $4 million. Bob gets the bear market first, losses stacked in those same early years. He runs out of money completely at age 83, more than a decade before Susan's money runs out. None of that is Bob's fault. He did exactly what he was told. He followed the 4% rule, the guideline that says you can safely withdraw 4% of your starting balance each year, adjusted for inflation, and expect your money to last 30 years. What that rule doesn't account for is a portfolio that never adjusts its mix of stocks and bonds, no matter what the market is doing around it. That's the hidden cost of a static mix. It doesn't protect you when a crash is fresh, and it doesn't grow with you once the dangerous early years have passed. You end up paying for stability during the exact stretch when you needed growth, and holding on to growth assets during the stretch when you could least afford another hit. Bob's expenses didn't hold still while his portfolio struggled either. The 2026 Social Security cost of living adjustment landed at 2.8%, which sounds small until you're the one living on a shrinking account, while your grocery bill and your property tax bill both keep climbing regardless. When your withdrawals are dropping and your costs are rising at the same time, that gap is what actually drains an account early. It's rarely one bad year on its own. Most advisors will tell you the fix is to get more conservative as you age, shifting steadily into bonds. But if you make that move after a crash has already happened, you've locked in the loss and missed the recovery that would have paid you back. You did the safe thing at exactly the wrong moment. So what if you flipped it? What if the retiree who started with the least stocks on day one was actually the one setting himself up to come out ahead? The strategy is called a reverse equity glide path, and it flips the traditional approach on its head. Instead of starting retirement heavy in stocks and gradually shifting to bonds, you start light in stocks and gradually shift toward them. In year one of retirement, a typical version holds 30% in stocks and 70% in cash and short-term bonds. By year 15, that mix has flipped, landing around 70% stocks and 30% in safer assets. The order matters because of what it protects. If the market drops 20% in your first year of retirement, that hit only touches 30% of your money, not the whole portfolio. Put real numbers on it. On a $1 million portfolio, 30% in stocks means $300,000 is exposed to that crash, not the full million. A 20% drop costs you $60,000 on paper instead of $200,000. That's the difference between a rough year and a retirement-altering one. You spend down the safer 70% first, the part sitting in cash and bonds, while the smaller stock portion gets an entire decade or more to recover before you lean on it heavily. I used to think the old age and bonds rule was gospel. For years, I told people to shift towards 60% bonds by the time they hit 65. I was wrong, or at least incomplete, because that rule was never stress-tested against a full 30-year retirement during a high inflation stretch like the one we've been living through. Retirement researchers, including work popularized by planners like Kitces and Pfau, and echoed in retirement guidance from firms like Vanguard and Fidelity, have shown something counterintuitive. A retiree who slowly increases stock exposure through retirement tends to capture more of the market's long-run growth than one who only decreases it. Over a 30-year stretch, that difference in exposure, combined with the protection built into the early years, is what produces gaps as large as the $2,100,000 example from earlier. That's not a rounding error. That's the difference between leaving money to your kids and running dry in your 80s. This sounds almost too good to be true, and that's usually where I'd tell you to be skeptical. You should be here too, because this is where the 2026 tax math kicks in, and it's the part almost nobody mentions when they show you this strategy. To move from 30% stocks to 70% stocks over time, you have to actually sell something to buy something else. Do that in the wrong kind of account, and the IRS ends up collecting more of your gains than your own family ever does. None of this works if you treat it as a one-time decision you make on the day you retire and then forget about. The glide path only pays off if someone actually keeps nudging that stock percentage upward, year after year, on a schedule, whether the market feels comfortable or not. That's a habit, not a headline, and it's exactly the part standard advice skips over. Building a reverse equity glide path means selling something to buy something else almost every year. To move from 30% stocks toward 70% stocks over time, you're regularly selling bonds or cash to buy more stock. That single mechanical step is where this whole strategy can quietly fall apart if nobody warns you about it. Do that inside a taxable brokerage account, and you trigger capital gains tax every time you sell an appreciated position. Do it inside a traditional IRA, and there's a second problem waiting for you. Once you hit age 73, required minimum distributions force you to pull money out of that account every year, whether the market is up or down, whether you actually need the cash or not. Put it in dollars and the picture gets clearer. A standard 4% withdrawal on a $1 million account is $40,000 a year. Now start layering in reality. State income tax if you live somewhere that taxes retirement withdrawals. The Medicare Part B premium, which runs $202.90 a month for most retirees in 2026. And if your income crosses certain thresholds, an IRMA surcharge on top of that, pushing your Part B premium as high as $689.90 a month. Add it up, and that $40,000 withdrawal can behave, in real spendable terms, more like a 2.8% withdrawal instead of 4%. That's not abstract math. That's the difference between covering your mortgage and your property tax bill without a second thought, and stretching every single month to make them. There's a piece of 2026 tax law working in your favor too, if you use it correctly. The One Big Beautiful Bill Act added an extra $6,000 deduction for anyone 65 or older on top of the standard deduction you already get. But that deduction phases out once your modified adjusted gross income crosses $75,000 for a single filer. If your reverse equity glide path generates enough capital gains in a single year to push you over that line, you don't just owe more tax on the gains themselves. You quietly lose a deduction you were otherwise entitled to, which raises your effective tax rate by more than the sticker number suggests. None of this means the strategy is broken. It means the account you hold it in matters just as much as the stock and bond mix itself. A Roth account, for example, doesn't carry the same required minimum distribution problem, which is exactly why so many retirees end up looking at conversions before they lean hard into a plan like this one. So the question becomes obvious. How do you get the growth this strategy promises without handing over a big chunk of it in taxes and lost deductions? It comes down to a discipline most people never build, and it has almost nothing to do with taxes at all. It's easy to talk about increasing your stock exposure every year when the market's been calm for a while. It's a completely different experience to actually do it when the headlines are calling it the next Great Depression, and your account balance just dropped in front of your eyes. If you feel sick watching your account go red and buying more stock anyway, that's a normal reaction, not a character flaw. Your brain is wired to help you survive a threat, not to optimize a retirement spreadsheet. Fighting that instinct with willpower alone rarely works for long, which is why this strategy needs a built-in guardrail instead of relying on discipline you may not have in the exact moment you need it. That guardrail is simple. Call it the 30% rule. If the stock market drops more than 30% within a 12-month stretch, you pause the glide path completely. You stop increasing your stock allocation for the next 12 months, no matter what the original plan called for. The goal isn't to squeeze out every last dollar of return. It's to protect you from making a panic decision at the worst possible moment, the same kind of decision that turns a bad year into a permanent loss. Picture two retirees living through a 2008-style crash. Panic Paul sells everything near the bottom because he can't stand watching the number keep falling. Systematic Sarah uses the pause rule instead. She doesn't buy more stock during the worst of it. but she doesn't sell either. She simply waits out her 12 months and picks the plan back up once things stabilize. Years later, Sarah ends up with roughly 3 times more wealth than Paul, not because she was smarter about picking investments, but because she never broke the strategy at the exact moment it mattered most. Ask yourself honestly, which one of those two you'd actually be in the middle of a real crash, not the version of yourself reading this calmly right now. That's exactly why the guardrail needs to exist on paper before you ever need it, instead of being a decision you have to make with your hands shaking. But maybe none of this feels urgent to you because you've got a pension coming in every month like clockwork. Does a reverse equity glide path even apply if you already have guaranteed income showing up no matter what the market does? That answer might surprise you. A pension is easy to overlook when you're calculating your stock and bond mix, but it behaves almost exactly like a giant bond you can't see listed on any account statement. Think of it as synthetic fixed income sitting quietly in the background of your retirement, doing the same job your bond allocation is supposed to do. The actual math behind that is simple division. A pension paying $30,000 a year is roughly equivalent to holding $750,000 in a portfolio of bonds yielding 4%. That's the amount of principal it would take to generate that same income at a typical bond yield. Now here's where a lot of retirees are quietly overinsured. If you have that pension and a separate $500,000 investment portfolio, and you put 70% of that portfolio into bonds because it feels conservative, you're not really sitting at 70% bonds overall. Once you count the pension as the fixed income asset it actually is, you're closer to 90% conservative across your whole financial life. You're leaving real growth on the table because a number on a statement doesn't tell the full story of how safe you already are. There's also a recent change that raises this floor even higher for some retirees. The Social Security Fairness Act repealed the windfall elimination provision and the government pension offset, the two rules that used to reduce Social Security benefits for teachers, firefighters, and other public employees who also collected a pension. If that applied to you, your Social Security check went up, which means your fixed income floor is higher than the standard advice assumes. You may be able to run a more aggressive glide path than a generic calculator would ever suggest, simply because part of your safety net just got stronger without you doing anything. If any of that sounds like your situation, the math changes in your favor, and it's worth actually sitting down and running your own numbers instead of guessing based on what a generic rule of thumb tells you. So if you're ready to build your own version of this, here's exactly how to put it together. Building this yourself comes down to 3 steps. Step 1, calculate your floor. Add up your Social Security benefit and any pension income you're entitled to. That combined number is the guaranteed income you can count on no matter what the market does in any given year. Step 2, build what I'd call the 5-year bucket. Take your annual spending and subtract your floor from step 1. Whatever gap remains is the amount you actually need your portfolio to cover. Keep 5 years' worth of that gap sitting in cash and short-term bonds, completely separate from your stock allocation. That bucket is what protects you during the early, dangerous years of retirement, the same years that sank Bob earlier in this video. It's the buffer that lets you cover the mortgage, the insurance premium, and the property tax bill without ever having to sell stock during a downturn just to pay them. Step 3, rebalance once a year. Every January, move roughly 3% from your safe bucket into your growth bucket, nudging your stock allocation up a little at a time. unless the 30% pause rule from earlier is currently active. I do this on the second Tuesday of every January. I sit down with a cup of black coffee, check where the 10-year Treasury yield is sitting, and make the trade. It takes about 10 minutes, but it's genuinely the most valuable 10 minutes I spend all year on my own finances. None of these 3 steps require a finance degree. They require a calendar reminder and the willingness to actually follow through on the plan you set for yourself before the next crash shows up and tries to talk you out of it. Write the 3 steps down somewhere you'll actually see them again, because the plan only works if it survives contact with a bad year. If this is the kind of math you want more of, subscribe to Wes Investor. We've got a deep dive coming on Roth conversions that pairs directly with everything you just learned about managing the tax side of this strategy. None of this is about being reckless with your money. The reverse equity glide path is about being mathematically sound at the exact moment. Everyone else around you is making decisions based on fear. You don't need to be a math genius to use this. You need to account for the 2026 tax rules we walked through, keep your 5-year bucket funded, and have enough discipline to keep buying stock a little at a time, even when the news is telling you to run the other way. Ask yourself which retiree you'd rather be. The one holding a static portfolio that never adjusts, hoping the market cooperates with whatever order of returns you happen to get. Or the one with a plan already written down, a floor already calculated, and a pause rule already built in for the year everything goes wrong. Retirement isn't the finish line for your investing life. It's the start of another 30-year stretch where market swings, taxes, and your own emotions are all still very much in play. Treat it that way, and the numbers tend to work out a lot better than the standard advice would ever have you believe. You spent decades building this money, one paycheck and one contribution at a time. Spending the next 30 years managing it with a little more intention isn't extra work. It's just the last part of the same job. If you found this useful, subscribe to Wes Investor. Let's get your retirement right.